Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Chicago soybeans. There had been here two main patterns on this daily chart. One had been driving the market higher longer term, and one pressing lower in the shorter term. Both of these patterns are broken with some resultant successful fallout from subsequent moves lower. But one of them is now looking to be possibly repaired. The first was a very shallow March to early June bear channel. It was not an ideal pattern, but it did fit in with recent action just about. It was also below what had been some considerable congestion formed over March and early April between roughly 1170 to 1193, which is very significant right now as prices are once more getting wedged within this congestion. This original move lower was prompted by the weekly key reversal down made 8 weeks ago, which formed the peak of a small, if imperfect, head and shoulders top, or even a nascent diamond pattern. The follow-on lower from this move down reached the targets for both the head and shoulders top and the diamond pattern, making a key break lower 4.5 weeks ago, but only below the December 2020 lower 1143, not only below that I should say, but more importantly breaking down below the main showrunner for this market since August last year, the dark blue lower time, currently 1163.25, of the second major pattern here. A consistent big picture item, the dark blue December 2024 to August 25 bullish Andrews pitchfork. I said on this move lower 5 weeks ago, and I quote, "This now leaves not only this pattern compromised, but it opens the way for a test of the gold long moving average below. It's currently 1129.75. The first time since the start of January this year, as well as possible tests of the 61.8% absolute Fibonacci line at 1105.75 and the pair of 50% Fibonacci lines at 1100.25 and 1098 even." End of quote. Since that statement, prices have dropped down to the gold long moving average, touching and bouncing up and away from the 61.8% absolute Fibonacci line and stabilizing down there between the 61.8% absolute Fibonacci line below and the December 2020 low at 1143, which was overhead. The stabilization over the last 4 weeks was potentially for either a further move lower as a possible bearish halfway hesitation or a bottom of sort. Last week it was too early to say which, but I did add 4 weeks ago, and I quote, "With this move down, we can now look at the whole March to date action as a possible wide double top Adam and Eve type." End of quote. Additionally, I added a week prior to this, so 5 weeks ago, and I quote, "We have even today gone so far that I feel obliged to lay out some targets below for this pattern. Of a primary target X down in 1114.5 zone, just under the gold long moving average, and a secondary hard to reach target X1 down in the 1078.5 zone. This could be quite a large move lower as there is limited supports below, so watch carefully." End of quote. 4 weeks ago, prices reached the primary target X, and whilst it may be that the gold long moving average is acting as an attractor, it's also worth considering 3 other supports below that were obstacles in the way to target X1. They are, first, and I think possibly the strongest, the 61.8% absolute Fibonacci line at 1105.75. The second is the 50% Fibonacci line of the August 25 to March 26 move at 1100.25, and a third, the 50% Fibonacci line of the May to August 24 move at 1098. These last two are close enough together that they can be regarded them as one. I think a congestion between 1098 and 1100.25. I commented last week, and I quote, "However, even looking at them this way, I still think the 61.8% absolute Fibonacci line is the greater support and obstacle in reaching target X1. This brings me to my final point, and it's an open question that deals with the main action over June between the 61.8% absolute Fibonacci below and the December 2020 low above at 1143. is whether to regard this action either a hesitation or a basing action. It's early as yet, but the longer the market stays within this band, the greater is the chance that it may be a basing action rather than a hesitation, so watch carefully. End of quote. My caution was justified in this as prices shot up from the open of this week, pushing up through the green short medium moving average, currently at 11.69 and the mauve medium moving average, currently 11.73 and as far as the previously mentioned congestion between 11.70 to 11.93, now threatening the retirement of the harder secondary target X1 below at 10.78.5. Indeed, the pattern over June is a double bottom, even atom type, and we have already reached all the targets topside for this one. There is one new item I'd like you to consider. It's my newly drawn bright red early January to late June bullish Andrews pitchfork. Prices are not close to any time right now, but it will be worth noting for the future. We are today in between the bright red lower time below, currently 11.16 and the overhead bright red middle time above, currently 12.49. Chicago soybean meal. Between January and early June, the market had moved up nicely within the main pattern here, which is a bull channel formed between lower and middle times of the late September 25 to mid-January 26 bullish shift pitchfork. However, 4.5 weeks ago, the market broke down through the lower time, as well as below the flatlining mauve medium moving average, currently 316.5, plus the congestion between 309.40 to 311.20, and back then below the slowly rising gold log moving average, which is currently at 309.20. And even testing below this, the important 50% Fibonacci line of the 25-26 move at 302.10, breaching it but not breaking it. I spoke of such a move lower 5 weeks ago when I said, and I quote, "Below this, well, apart from the congestion from January this year between 293.5 to the 50% Fibonacci line at 302.10, well, there is nothing much. And I should say, with the overhang of the market since February this year, I could easily see that being tested." End of quote. Thus, this move down was what was effectively a January to early June bull channel, left us with some targets below of a primary target in the 305.20 zone, which was reached, and a secondary hard to reach target X down in the 292.90 zone. This secondary target X would be a significant drop, close to the lows of this year, though I thought at the time not perhaps as hard as it first seemed, as there seemed to be little support apart from the congestion from January and February down at those levels. I said last week when the market was still contemplating such a move lower, and I quote, "It all depends if prices can punch down and stabilize below the 50% Fibonacci line at 302.10. If we do, watch out for the possibility of a further move lower. The whole late May 2-date action looking like a possible bearish halfway hesitation. Right now it is an open question whether the action over most of June is a hesitation before a move lower or the start of a basing action. I do know that the longer we stay down here, the greater is the chance of it becoming a basing action, so watch out." End of quote. Well, my caution was justified, as from the start of this week, prices have turned higher, thus threatening with retirement the harder secondary target X1 down at 292.90. Prices have pushed up and stabilized over the gold long moving average, as well as over the interesting dark blue trendline extension, currently 310.40, to the July to September 2021 descending triangle. However, the rise has been tempered by the overhead bright green short medium moving average and the mauve medium moving average, which is an interesting development. All this has led me to draw a new pattern on my daily chart, which is not directly influencing the market right now, but will, I suspect, become important in the future. It's a bright red mid-January to mid-June bullish Andrews pitchfork. The market in between the bright red lower time below, currently 302.90, and the overhead bright red middle time, currently at 326.30. This leads me to my final point. And this commentary would not be complete without my discussing a portion of my commentary which I have been repeating here for 162 weeks, so for 3 years now. It is to do with the annual key reversal seen here at the end of 2023. I said back then, and I quote, "I now only need to remind you once again of my words when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023 and I've been living in a shadowless pattern ever since." End of quote. I've also added ever since, and I quote, "If there's only One thing you take away from any of my musings, let it have been those words. End of quote. For 3 years, a shadow of that pattern has darkened the skyline of this market ever since. I wondered if prices were now finally sending that shadow to oblivion. Once again, it does not seem so, as we're still significantly below the close of 2023. Chicago soybean oil. There's one pattern here that has defined moves higher this year, even when it was being thoroughly tested. It's the bright pink March to August 2025 bullish Andrews pitchfork, with the market today just above the bright pink middle time, currently at 68.01. And the rising mauve medium moving average also there, currently at 69.32, but below the green short medium moving average, currently 72.47. The most recent pattern formation here was a turn of May to June horn top, which is part of a mid-April to late June lopsided double top. This latest move low was prompted by the horn top negating an earlier weekly key reversal up. The primary target for this double top was reached 3 weeks ago, but the harder to reach secondary target X down at 64.85 was not, and is not in danger of, and is now in danger of retirement. I said about this last week when I said, and I quote, "It is still there, though target X is stuck at the lower end of congestion dating from March this year, and I'm having doubts if prices will drop all the way down there." So, you can see from my skepticism, and it was not a total surprise, to see prices rally up this week. Interestingly, this helps something I have been saying for the past few months when I said, and I quote, "I think for this market, the question is not whether the market is bullish or not, but how bullish does this market choose to be?" End of quote. This is now the 7th week, and the bullish incentive has indeed seen some heavy dampening, but still not extinguished. You only need to look at the pink middle time or to the whole bullish pink Andrews pitchfork to see the close association of the pink lower time below, currently at 59.12, running right from the start back in December last year, to the close association with the rising gold long moving average near it, currently at 60.47. However, there is what 2 weeks ago was a developing factor is now set in stone, which may in the future have a significant impact on this market. It is the monthly key reversal down in this market seen in June, all the possible implications that may have. I should now point out this monthly key reversal down is not alone, as we have seen similar monthly key reversals down in most of the other oilseeds and veg oils. For the moment though, this factor is isolated. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.